Alrighty, so now we're going to talk about consolidation, or the market moving sideways. As stated before, the market moves only three directions. We have up, down, and sideways. There's no other way that the market moves. So as long as you understand market structure, that'll give you a higher probability of being in the correct trend. You know what I'm saying? Or of getting in the trend, putting like a buy for a buy trend instead of putting a sell for a sell trend, because you'll know exactly what's going on, right? So chart moving sideways is basically, you hear a lot of people call it consolidation because it's consolidating, or trends or orders are being consolidated, or accumulated, or even distributed. Which, I could get into this video, but I'll get into more about that on the intermediate section, because that kind of blends into the institutional order flow and the order flow of the chart as a whole versus just the structure. So right now we're just talking about the structure of the market, candlestick patterns, Fibonacci, stuff like that. We're just talking about the basics that just about everyone is teaching, but it's just the basics. So you still have to know this stuff, because this is even though it's entry level stuff, you still have to know this stuff, because these are tools that we'll be using as confluence and as confirmations in order to stack on top of each other for higher probability wins, right? Because that's the whole goal. I got to the point where my confluence is it works for me. You know what I'm saying? I'm gonna show you exactly what I mean when we get to the intermediate and the advanced. But for right now, back to the subject at hand. Consolidation, it'll typically show equal highs and equal lows. You know what I'm saying? It'll bounce within a range and move sideways. There is not going to be any higher highs. There won't be any higher lows. You'll just see it moving sideways. The general retail traders call it consolidation. When we, look at it, the actual term for it is either accumulation or like distribution zone, a distribution market, right? So it's either accumulating orders or distributing orders, right? So equal highs, equal lows, looks like price is moving sideways. Very simple stuff. If let me see. There you go. Do not trade unless you're 100% of the breakout direction. What I mean by this is, you see how it's going up, down, up, down, up, down. Don't put in an order unless you're 100% sure that when it breaks out, it'll go the direction that you want it to go, right? There's a method to this. There's a science to this, which I'll be explaining in the following videos in the other section. But when you see this, you could just stay out of the charts. Don't trade. Or if you're gonna trade from this zone to this zone, this zone to this zone. You put a trade here and put a take profit here. Put a trade here. Put a take profit here. Do it that way if you're gonna trade this, right? So let's pull up a chart so we can look at a consolidation based on candlesticks. Okay, so now we're back with GBP JPY, and what we see right here is a high, a low, another high, another low, and we see that the market is moving sideways within a range. It's moving sideways within the range. So high, low, high, came back, tested that high, low, came back, tested the low, high. Notice over here it broke out. Remember I told you, don't put a trade in unless you know when it's going to break out. A lot of, regular basic retail traders will put the trade in once it breaks out of the zone, only to be faked out and for price to go back into the range and shoot the opposite direction. As the market is one big machine of manipulation, you have to be able to understand these moves. Manipulation, I'll go more deeper into manipulation in the intermediate section as well, because that goes hand in hand with the institutional order flow. But this is basically a manipulated move to stop people out, or even to trigger buy stops, pending orders. So for instance, if someone put a sell here, now let's do it here. If someone put a buy here, it's tripping again. Hold on. I might need a new graphics card, the way this thing is going. Alright, so here we are right here. Alright, so if someone put a buy here thinking it's going up, or even if they had a buy stop here, basically a buy stop is a pending order. When the price hits a specific zone, it'll trigger a buy order. Typically, individuals who put pending orders of buy stops, they'll put a buy stop up here because they think it'll when it break out, it'll keep going up. So for instance, let's pull up my path. They think it's gonna do something like this and shoot out, but as you can see, it went up and came right back inside. So what happened is the buy stop was triggered. The buy stop was triggered. Let's say if this was the buy stop, they put a buy stop here. If they didn't have a sell stop with it as well, this is what their trade will look like. Straight negative, right? So let me see if I can get this back up. Yo, it's not going back up. All right, so this is a hunt. Usually when this happens, there's a consolidation. There's a lot of orders up here. There's buy stops, and there's also sell limits, and there's also stop losses. We have stop losses for individuals who think it's going to go down. So they'll open let's say if they open a trade here, and they have a stop loss like right there, and their target is down there because they think it's going to go down when it breaks out. I don't know why this thing coming out like that, but the market can see all of it. The market is controlled by institutions, right? So the whole game is to hunt orders, hunt liquidity, hunt orders, so they can move the money. So this right here was a hunt to close out all of the stop losses, all the stop losses. So whoever put the order here and put a stop loss above the zone, because they probably saw this wick here before, so they put it above the zone, it got tapped, closed their order, and still shot down. For anyone who had buy stops, for it to go up, set up here, for it to go up, if they had a stop loss, it triggered the buy stop. It started going up, but then it came right back down and closed out their orders and went down. If they did not have a buy stop, there'll be a negative and probably a blown account. So this is why a lot of people do not recommend trading consolidation and accumulation and distribution. They don't recommend trading it because you never know what's going to happen. Now the difference is, when I keep saying accumulation, distribution, this is the difference. This is considered, where's my box? This consolidation is considered accumulation. So price orders are being accumulated all down here, right? This is the accumulation zone, right? So it came out of that zone, bounced out, and this is a reaccumulation. So more orders are being accumulated here. So it shot up, came back into the zone, and now this is a distribution where orders are starting to be distributed. So, or price or money, the money is starting to be distributed. So you have to think of this in terms of money. This is the discount price. Let's say $126, let's do $127, right? That's the discount price. That's the lowest price. So they bought. So all these orders were put in to buy. They buy. More people were buying here. Orders being accumulated. And there's a lot of buys. There's some sells. Buys, sells. Orders being accumulated. Then it shot up to get the high. Like I told you, the entire market is manipulated. I'll get more deeper into this cycle in the other videos, but it shot up. This is a manipulation move from the institutions. It shot up in order for them to start closing out what they bought at a discount. So them moving the money from the 127. Once you get up to 147, they start closing their positions and the market start going down. And so once they start closing their positions here, you start seeing more selling momentum, right? So you start seeing more selling momentum. So it was pushed up so they can have the best possible selling price. So from 127 to 147, best possible selling price. When it went back down, this is redistribution. So this is the reselling price. So again, sales are being put in until it finally tanked with all the sales and went back into the accumulation zone. So that's the difference. This is an accumulation. Accumulations are basically accumulating orders for buys, where distribution are set for distributing the money, right? So, or the price. So that was one example of consolidation. This is another one right here. It's moving sideways until it actually broke out. Another sideways move. But that's consolidation. It's really not hard to understand. Like with consolidation is just consolidation, right? It's just moving sideways. But we can look at other examples if you want to see other examples. And this happens in every time frame. So you have one right here, some right there, right here is consolidation. This is consolidation. all right, here's pretty much consolidation, right? You see the highs. So that's that. So remember, the sideways move in the market is called consolidation. There's accumulation and distribution markets. They both consolidate. You have equal highs and equal lows, and it looks like price is moving in a sideways motion in between a range of basically a high and a low. You do not trade consolidation unless you're 100% sure of the breakout direction.